All right, this video is for options traders and for those people who are looking to trade options. And one question that we get a lot over here at Netpicks is the basics. What is an options premium? So that's what we're going to talk about today. So let's just start off by saying that an options premium, what that is the current price of the option that would need to be paid by the buyer to the seller. So when you look at the price quotes in your platform, you're going to notice that they're quoted per share. However, each options contract represents 100 shares of stock. For example, looking at Apple, you'll see that the $332.50 call options trade for $6.40. So that's $6.40 is the current premium for that particular option. Each option contract is going to represent 100 shares of Apple stock. So it would take $640 to buy the 332.5 calls from the seller. Now, regardless of whether you're looking to buy or you sell, it's important to understand what the factors are that affect the options premium. And there are 4 inputs that impact the premium. And before we touch on those, I just want to show you this free PDF. You can download this. It was written by our in-house options guru, Mike, and he calls it the 8-Minute Options Trading Cookbook. And basically, it's his favorite strategy for generating income in options. So it's free. The link is above or below in the description, and you can download that anytime you want. So what are those 4 factors? The stock price, the intrinsic value, the implied volatility, and time value. Now, keep in mind, as the price of the security changes, the options premiums is going to change. So let's talk about the stock price. Now, most traders, when they start trading options, they have an understanding that when you buy a call option, that's bullish, and you're looking for the stock to move higher. Buying a put option is bearish, where you're looking for the stock to go lower. Now, as the stock value increases, the premium of the call option, that's the one where you're bullish, will increase while the put option decreases. And the opposite's true as well. When the stock goes down in price, the premium of the put option will increase while the call options decrease. Now, that's an important piece to trading directional options, but we have other factors that can have just as big of an impact. The intrinsic value. How far away the stock price is from the strike price of the option, that's referred to as the moneyness of the option. Now, what the intrinsic value is, that represents how far in the money the option is. So a call option, for example, is considered in the money when the stock price is higher than the strike price of the option. An in the money call option is worth more money to the options buyer. For example, if you own Apple, the 320 calls with the Apple stock trading at $333.46, the 320 calls would be $13.46 in the money. That's just calculated by taking the difference between the stock price of $333, the 320 strike price of the call option. So in other words, the 320 call option would have $13.46 of intrinsic value. Now, a put option, that's considered in the money when the stock price is lower than the strike price of the option. So an in-the-money put option is worth more money to the options buyer. An example on that, if you own Apple, the 350 puts with the stock trading at $333.46, the 350 puts would be $16.54 in the money. And we calculate that by just taking the difference between the stock price and the 350 strike price of the put option. So in other words, that 350 put option would have $16.54 of intrinsic value in this example. So as the option goes further in the money, the option will typically increase in value. We're not taking into account the time value or implied volatility. So that just makes the in the money options more expensive for the option buyer. A call option is considered out of the money when the stock price is lower than the strike price of the option. A put option is considered out of the money when the stock price is higher than the strike price of the option. Now, out of the money options, they have no intrinsic value. What about implied volatility? In simple terms, the implied volatility is a prediction of future stock volatility. It's the value that's being used in the options pricing model to generate the current options premium. Implied volatility is the options pricing factor that a lot of traders overlook, but it has a huge impact on the performance of your trade. High levels of implied volatility, that predicts bigger moves back and forth in the stock price. This uncertainty is going to be priced into the options, which will lead to a more expensive price. When you have low levels of implied volatility, that's going to predict smaller moves back and forth in the stock price. Now, this lack of uncertainty is going to be priced into the options, which will be a cheaper price of the option. So as the implied volatility increases, the values of the options increase faster. When the implied volatility decreases, it causes the options premium to get cheaper. If you're buying options, you ideally want the volatility to stay either steady or increase during the lifespan of the trade. If it increases, you're going to see a bigger profit potential. If it decreases while you're holding the trade, it's going to lower the option premium, which can cause you to lose money or just not make as much profit as you expected to on the trade. If you're selling options, you ideally want that volatility to decrease from the moment you put the trade on. As the volatility decreases, the options premium gets cheaper, which will allow you to buy your options back at a cheaper price. The cheaper the premium gets, the more money you make on the trade. Let's talk about time value. Now, options are a decaying asset, which means that every day that passes, the options premiums get cheaper. There is more time value in the options premium the further out in time that you go for the expiration date. You're going to pay more for the option the further out in time that you go, because that's going to give you control of the position for a longer period of time. However, options will lose value at an increasing rate the closer they get to expiration. This is known as decreasing in a nonlinear fashion. So, while paying a cheaper option premium on an option that has less time to expiration looks attractive, it also means that the time decay becomes more significant with every passing day the closer you get to the expiration date. Time value, that's the enemy of an options buyer, and it's a friend to the options seller. So as a buyer, you want the stock price to move in your favor as quickly as it can to avoid the time decay, which will take some of your profit potential. Now, as a seller, you want the options premium to get as cheap as possible. Every day that passes, that's your friend when selling options to open a position. So what's the bottom line? Trading options, they don't have to be overly complex. However, understanding the factors that impacts the options premiums, that can help you select the best trading strategy to maximize your profits based on your outlook for the stock. When you pay attention to the stock price, the intrinsic value, the implied volatility, and time value, that will lead to bigger profits from your trading. So if you have any questions, put them in the comments. I've also put in Mike's email below, and you can send him an email as well if you have any questions. And I hope you downloaded that PDF. I'll give you another opportunity to do that on the next screen here. Thanks for watching, and hope you got something from